Welcome to Commercial Real Estate Pro Network CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's sponsor is Building Insurance and Risk. When you invest in real estate, work with the experts at Building Insurance and Risk. You will receive multiple coverage offers with a side-by-side coverage comparison. To learn more, go to buildinginsuranceRisk.com. Today, my guest is Craig Berger. Craig founded Avid Realty Partners in 2015 after spending more than a decade on Wall Street as a multi-award-winning equity research analyst. The firm's portfolio has grown meaningfully in recent years and includes acquisitions and operations of over 1,450 units in secondary and tertiary markets throughout the United States. And in just a minute, we're going to speak with Craig about Wall Street versus real estate. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Craig Berger. Welcome to CRE PN Radio.
Darren, thanks so much for having me. Really excited to be here.
I'm looking forward to our conversation today. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. Yeah, I studied accounting in school. Went into corporate finance at Intel Corp. Out of school, did a few years working at Intel Corp, sort of learning how to run a large business, learning a lot about semiconductors. I'd always been interested in Wall Street, so went to go work for Citigroup Smith Barney to go write equity research for their semiconductor analyst, and that sort of launched me on a 12-year career in research on Wall Street. That was a good run, but my portion of Wall Street was shrinking, and I really wanted to roll up my sleeves and do something entrepreneurial. And so at the age of 37, I walked away from my desk job and set about to build something meaningful, and found my way to multifamily and commercial real estate as a way where I could deliver investor returns and hopefully do good things for our residents and the community at large, and be a more active entrepreneur than I was able to be working for large investment bank brokerage firms. And so that was sort of my journey.
Got it. As a research analyst, were you I guess one of the things I think of, excuse me, on Wall Street, I usually think a lot of like excitement, big trades and stress and all that kind of thing. As an analyst, can you describe kind of what your role is in that, or what it was?
Sure. So we sell side equity analysts typically cover one sector and have expertise in one sector. I covered semiconductors. We formally cover 10 to 20 companies in that sector, rate those stocks a buy, a hold, or a sell, publish formal research with earnings estimates that all get sent to Thomson Reuters and get aggregated among all of the analysts that cover NVIDIA, for example. So the street expects 78 cents of earnings this quarter. Well, I was one of the analysts that helped to comprise the street. But essentially, we would perform analysis, make stock picks, provide recommendations and advice to our hedge fund and mutual fund clients, as well as to our bank's internal traders. And our clients, our hedge fund and mutual fund clients, would typically pay the firm for the research by executing trades. I believe that executing trades for research is no longer allowed, but that's basically the role. Back in the 80s and 90s, there was no regulation, fair disclosure. The information flowed more freely between the C-level executives at the companies and the research analysts. But now information is supposed to be disseminated all at the same time. The hedge funds can't pay for research and trades, and so frankly, the role of the research analyst is sort of continued to shrink. There's always a place for it for deep analysis and expertise, but it's not as large of a role as I think existed in the 80s and 90s. I myself was not making trades. There was definitely an opportunity to move over to hedge fund or mutual fund companies for employment to work on that side. That's the buy side. They're buying the research ideas, the trading execution. The sell side is selling the research ideas and the trading execution. And so that's sort of the background on sell side versus buy side. The buy side is definitely more of a world of actual practice and implementing real trades and real risk management. The sell side is a little bit more of a world of theory. Hopefully that background is helpful.
No, I appreciate you sharing that, because like I said, the analyst, I don't know of any movies that really show the analyst, hard at work, kind of reading and talking with, people and trying to come up with a conclusion. It's usually the buy, sell, kind of a reference point when I think of, Wall Street or the trading floor kind of thing. But I'm curious, given that was your position as an analyst, it sounds a lot like an underwriting position, that would be a good fit for real estate when you're looking at assets, either to buy and or to liquidate. Do you find that training transfer, did the skill set transfer, and did it help you with when you got into real estate?
Um, Great question. A lot of the skills do transfer, and then I've had to build and learn a whole new arsenal of additional skills. But certainly being on the sell side, coming from that Wall Street world, gave me the good fortune of underwriting companies and their financial futures on a very regular basis, tracking actual results versus plan or budget or forecast, living and breathing the stock market, the ups and downs, sort of riding the economic cycles, which is particularly relevant today and where we are, with the "don't fight the Fed" type of mentality. We've learned, risk management. I got to spend time with C-level executives that were doing that were executing at a very high level, or perhaps folks that were executing at a lesser level, and so that was a great training ground. Obviously, it is a very theoretical kind of thing, and so when I cut over to real estate and really started from scratch, it did require learning a whole bunch of operational, entrepreneurial, and sort of in the weeds skills that are particular to real estate. But I brought all of those other research related skills with me, and importantly, developing an institutional mindset as we approach our assets and growing our business.
No, I would think that's again, an interesting transition, and like I said, there's more to learn, but just kind of background stuff. And you mentioned, having had that I guess the publication side as an analyst, where you were publishing your expectations and that. I'm assuming, and you tell me, does that help you when attracting capital or presenting a prospectus or preparing a prospectus for investors? Or because it seems like they'd be somewhat similar in the structure and what you're trying to convey, or just that speak. Is there any transfer there?
Our investor pitch decks are very thorough, and I think they look good. I've been told that there's as much good information in our pitch decks as folks have seen. A lot of times I'm putting that information together for myself and my own analytic curiosity. So yeah, I think it helps, right? We also, of course, write quarterly investor updates that tend to be pretty thorough. Other original content. At a certain point in running and founding this business, I can't write every investor update myself. I can't write every bit of sort of engagement content myself anymore. So it does help, and also doesn't scale perfectly.
Yeah, I get it. So, real estate, you mentioned you're ready to leave Wall Street. What was the attraction to real estate?
So my Wall Street career was great, but I really wanted to set out on a path of independence. I wanted to set out on a path of self-control and self-determination, where I could take control of my life, my career, my future, and not be dependent on others. And I wanted to build a business that had the corporate culture that I want, um, that treats people the way that I think they should be treated, and where we can build meaningful wealth for ourselves, our employee team members, our partners, and be in a position to do great things for our customers in need, or the community at large. Um, it's a long journey. This is not something that happens quickly. There is no such thing as get rich quick. Real estate is, if you work hard and are smart, you hopefully can get rich slowly. But there's no shortcut around time, persistence, smart decision making, value identification. But really, I set about on this journey, this long journey, to build something meaningful and have control over my own destiny.
No, I like it. Uh, when you first started, did you start with creating the firm, or did you start investing on your own, or how did that look?
Well, I didn't know what I wanted to be when I grew up. Um, it's still a period of self-discovery and creating an identity. I know a lot more now than I did back in early 2015. So we had to throw spaghetti at the wall, try a bunch of different things and see what worked, what didn't work, what we like, what's good for me, what I'm good for with projects, and so on. So it's been a journey of self-discovery and growth and learning. I did buy my first deal in 2015. It was a total of $375,000 of equity for a 95 unit apartment building at in a demographically um, challenged location. Um, you can imagine that we didn't fully um, capitalize the project as much as it probably needs. 95 units, 375,000 of equity. But we did well, and we did a value add program at that property. We focused on improving safety and security. Then we started upgrading units and common areas, and riding the journey. Um, I bought and sold a couple hotel properties. One sort of value add exterior corridor property was particularly challenging, but that was a similar value add type of deal. Our total project on 110 doors. Um, I bought one net lease property, so I've dabbled in various food groups, and explored and discovered, and really multifamily is our main business, our only business today. But there is this period of self-discovery. I think, you know, had I gone back and done it differently, maybe I would have gone to work for an Angelo Gordon, or a Blackstone, or a real estate investment firm, and learned the business and gotten some credentials. Maybe that would have been easier. Maybe that would have been smarter or more risk managed. But that's not my journey. That's not what I did. That's not who I am. And so I've sort of done this my way, and I'm not sure if I have regrets or don't have regrets, but it just is what it is. This is my path, and I'm not going to pretend to have been on any other journey than what I was actually on.
No, I'm still curious to learn more about the 95 units for 375,000 in equity. That sounds like a pretty, uh, I'm guessing there's a lot more to that story there. Um,
Well, we bought it on an auction site. We got a great basis. We didn't fund any of the capital improvements. We took that all from cash flow. When my property manager, the one that I inherited when I bought the deal, when she quit on the first of the month, I flew into town to go be the property manager myself for 6 weeks. It was my only asset, and failure was not an option. So I learned a lot about property management and asset management, and um, dealing with residents, dealing with issues that come up, and learned sort of empathy for what property managers face on a day in and day out basis. And so now when I go and see my property managers, I have unlimited gratitude and appreciation, love, respect, admiration for all that they bring to the table. Sort of a formative experience that I'm thankful that I didn't avoid.
yeah, no, that sounds like rich learning environment there to, jump in feet first like that. And it sounds like there was some opportunity to improve the property there. So just out of curiosity, it sounded like that's a value add opportunity. Uh, how long did you keep it before you guys exited that?
Um, so we've about 7 years.
Okay. Oh,
Yeah.
so just recently then
I
you
I
ex-
actually, just to be clear, I still own that asset.
oh,
I own
okay.
one other asset, and they are being marketed right now for sale. And I'm sort of emotionally attached to that asset, which is never a good thing. But you know, it's my first deal. It sort of holds a special place in my heart, and the staff that have been there with me for 7 years are like family. And we've done well. So we refinanced the deal back in 2018, and we sort of had a 3x of our capital on a refi. So we're sort of already playing with house chips on that asset. And um, you know, the environment's a little more challenging right now to sell any asset. I think it's a home run basis for the next owner. And we're sort of working through the details of that. And one of our other legacy assets, it's about a mile away. It's sort of a two-pack, 204 units, and I still think a great basis for that two-pack.
Got it.
So we've
So
owned it. We've owned it for 7 years, and I'm considering parting ways.
gotcha. Well, that sounds like again a great starting point. Sounds like it's done well, and wish you well with the your exit on that. If you end up selling it, sounds like that's always a possibility. Might not. Um, so you got the first property. Was that did you do that as a syndication? Did you have partners? How did you go
So
about?
so because it was a very small amount of equity, I put in about half of the capital personally, and then I had two partners put in the other half of the capital.
Gotcha. And
I,
it,
I I had no experience or track record to go out and syndicate. And then
right.
with the second deal, I was able to convince a few friends and family to support me on the value add hotel deal. Um, we did that. That was successful. Uh, Obviously these play out over a period of years. And then I bought a few other, smaller deals. I bought my first institutional asset in early 2018. So it did take about sort of 3 years to work into what I'd call my first institutional asset. And thankful for the institution that invested, roughly $5 million of equity into that deal for us to buy that. And um, uh, have a great relationship with those folks, and gratitude for them giving me an opportunity. And I think ultimately we delivered for them on that asset.
Got it. You mentioned the hotels, and I know that currently you guys are focused on multifamily. Um, were you actually operating the hotels then as well, or was it just a property acquisition you lease out, or how did that work?
So I had a partner on the deal, sort of a junior equity partner on the deal, who had hotel experience, hotel operations experience. We did self-manage. I've sort of been through this self-manage versus third-party manage debate in my head on a number of assets over and over. But we did self-manage, and again, sort of another rich learning experience, and a sort of a night and day change from working for investment bank firms, and then moving over to this in the weeds series of experiences. But adversity makes people strong, and doing a variety of different things sort of has given me perspective. So we did self-manage, and that was challenging, and I did have a partner that helped me on that front.
Gotcha. So you moved from Wall Street, you're into real estate. Um, if you were to compare the two as far as like an investment opportunity, um, how do you position, or how would you compare like a stock as opposed to real estate? What are the things that you see, or that your investors are appealing to your investors?
Well, it's a fantastic question. um, I think there's a place for equities and a balanced and diversified investment portfolio. I think there's a place for real estate and hard assets in a balanced and diversified investment portfolio, as well as, depending on your age, bonds, all other alternative investments, private equity, potentially some modest exposure to crypto. But here's how I think about stocks. You're kind of riding the market. And if the market goes up, your portfolio's up. If the market goes down, your portfolio's down. Back in the day, hedge funds were actually hedged. They would be, you know, long Google, short Facebook. And if the market went up or down, it didn't matter. And if Google outperformed, it did matter. And they were protected against market moves and hedged. Very few hedge funds or investment managers on the equity side are really hedged today. And so you're really just riding the market wave. Um, and so, since 90% of hedge fund managers do not outperform the S&P 500 on a net of fee basis, it probably just makes sense to own S&P 500 index fund and other index funds for your equity exposure, unless you're really good at picking hedge fund and investment managers that outperform. So stocks I don't view as being particularly controllable. You're just sort of riding the market, and that's fine. Um, on the real estate side, I think it's totally different. Real estate sponsors have the ability to um, make their money going in, buying value. A lot of the process of owning a multifamily apartment investment is controllable. Expenses are more or less known. Um, Debt is forecastable within a range. There's really only a few things we don't know as multifamily operators, and that's, sort of what does top line growth really look like, and what sort of multiple can we achieve on the property when we sell it? What kind of cap rate or selling price can we achieve down the road? So a lot of it is known and controllable. I don't want to say it's formulaic at all, because it's not, but I feel like I have more control over a multifamily investment than I do over my stock portfolio. So that's sort of how I think about it. Um, there's obviously some well-known and well-discussed benefits to real estate investing. You've got ongoing cash flow. Yes, you have appreciation. You've got tax favored and tax advantaged status. You get cash flow distributions that are typically not cash, not treated as income because of the depreciation protection. Your income or gains down the road are treated as capital gains later instead of income tax rates in today dollars. And importantly, real estate, while slow, can be non-correlated or less correlated with the global moves in the equity markets and whatnot. So it's a good balance, and I think it's controllable. Obviously, you have to pick great sponsors, or participate in some other way. So that's sort of how I think about stocks versus real estate.
No, I appreciate you you doing the comparison there. As far as a real estate investment philosophy, can you provide kind of some of what your guys is how you operate? Is there particular markets you look for, or size, or it sounds like value add is kind of a strategy, but just a little bit of what you're looking for in properties that you're acquiring.
Sure. Yeah. So, in terms of markets, we like markets that are growing. We like in migration growth markets. Most of the units that we've bought have been in Texas. I think Texas is a great market, sort of, a business friendly environment. You got a lot of Fortune 500 and 2000 companies that are moving there. Obviously, we want to invest where people want to live. And where it's easy to operate. I'm in New York. I live in New York. I've never done an investment in New York because there's so many rules and laws and regulations and complications, and I just, I don't know what I can or can't do here, and I don't really feel comfortable putting my own or other people's money to work in an environment where I don't know what I can or can't do and what's legal or not legal, and it's just too complicated. I'd rather be simple. To me, simple is places like Texas, Florida, the Carolinas. Um, uh, you know, Nashville's a good market. I do like some of the markets in the Midwest where you get a little more value for your money. Maybe you get less appreciation, less job growth, less rent growth, but a friendlier entry cap rate and purchase price. Places like Columbus, Cincinnati, you know, Indianapolis has been pretty good. Kansas City has been pretty good. So it would be sort of a complement to some of the faster growing markets in Texas and Florida. I mean, I do like Vegas a lot and Phoenix a lot. Those are two markets that I've never been able to make the cash flow work. I've never been able to make the numbers work. So I've never bought anything there. But I've lost because those markets have gone up among the most of any. It's a tough pitch to buy at a 3.2 cap and improve it to a 4 cap and sell it again for a 3.3 cap. I haven't been able to get on board with that, but again, my loss. So we like to buy in growth markets. We're building a diversified footprint across markets. In terms of asset class, we buy A's, B's, and C's. I've obviously come up in C's, but I think it's helpful to have a diversified footprint of newer assets at higher prices and older assets at lower prices, and a mix of demographic exposures. So, we're not getting negatively impacted by any one trend at any one point in time. That's sort of a longer term vision. I don't necessarily have enough scale today. We've bought roughly 2,000 units total over our history. So I wouldn't say I have enough scale to have fully executed that plan, but that's sort of the longer term vision. Does that answer your question?
Yeah, no, I appreciate that. Do you guys operate in a syndication model now, or do you have a fund, or how are you
So we're in the final stages of forming our first fund. One of the reasons that we're forming a fund is that we can take investor dollars 24/7 at any point in time, rather than sort of racing the clock and saying, hey, we have 40 days to fund this deal. Here's the deal. Do you want to see the deal? Are you ready to invest and get your checkbook out rapidly? And I'm not really into the I'm not really into the whole pressure cell thing. So I'm trying to get out of the purgatory of racing a 40-day or 60-day clock to, as fast as possible, raise money and get the deal done and so on. But, I have lived in that zone. That's still where I'm living, and we hope to hire and scale and grow. We're hiring a lot right now, and we've sold some deals early this year, late last year, and we're taking those resources and redeploying into people, processes, and systems right now to build out every facet of the company. And building out means hiring folks to handle our capital markets and capital raising efforts, and handling people to source more and better product, and handling um corporate type of folks to handle the back office infrastructure and management of the investors and the product. And so we have been in the syndication model. Sometimes we'll um, work with an institutional investor who comes in for 60, 70, 80% of the deal, and then we syndicate out the rest of the deal. So it's sort of a mix. Um, and we're deal by deal today, but looking to move more towards a dry powder, on balance sheet capital type of model in the future.
No, I think that's kind of the progression. I hear, firms, as you get experience and then have a track record of with investors and stuff, that the fund model gives you a lot more flexibility. So I appreciate that. Um, as far as managing your assets, do you guys do you have a in-house management, or do you sub out management and all your other services?
So on our two legacy assets in St. Louis that I talked about earlier, we do self-manage, and that's because they require a great amount of care. There's not really that much scale, and you have to be really committed to managing those locations. So we do it ourselves, and I have a full-time partner on the ground in St. Louis who takes the leadership role and allowing us to self-manage those assets. And it's been, again, a great learning experience. On the institutional assets, we do utilize third party. We've typically used Roscoe Properties, RPM Living in Texas for our Texas-based properties. They've executed at a high level for us. There's other great management providers out there as well. But we take a very hands-on role with the asset management work that we do. We have a bunch of sort of key performance indicators and spreadsheet trackers that we're tracking our properties on a weekly basis, to make sure we're getting maximum performance out of the properties and maximum engagement with the third-party property management providers, and getting the most work and effort and results out of any third-party provider. It's usually a positive attitude. We're one team, one dream. We all want the same thing. We want to make the asset perform at peak levels. But we do, take a very sort of focused approach on ensuring that these assets perform, and we're very hands-on at every facet of owning these assets. So it's not really a casual process. It's a very engaged and focused process. And I have so much gratitude for the hard work that the third-party folks put into these properties. It's not an easy business. It's a very hard business. You're dealing with people's lives, people's homes. It can occasionally get messy. And I try to keep that in mind. And every time that I'm dealing with folks from maintenance people, on up through regional VPs or the owners of these third-party management companies.
No, well said. Um, as far as the multifamily marketplace right now, you've been doing this long enough to see kind of the trend for the last 5 or 6 years, and now we're entering into kind of a new phase or a different phase with interest rates. Do you have any kind of expectations or a sense as the former analyst? Do you have any kind of future view to what you're expecting the market to do, or do you have any kind of thoughts based on what you're seeing in the market right now?
Wonderful question. Everybody has views, thoughts, and opinions. Mine isn't any more important than anyone else's, but look, half the country rents, and there's always going to be demand for apartments, so that's good. That's good from an ownership perspective. Prices have definitely come down quite a bit in multi over the last 6 months. It's still hard to make these deals work. There's still most properties selling at a 4 cap, and we're now out borrowing at 5.5 fixed and 6.5 or 7% bridge. So it's still hard to make these deals work. Rents have obviously gone up a lot. I think there's still some catch up to be had for a lot of properties, but this inflationary period is mostly behind us at this point. And I think that's true for the broader economy. I think we're past the worst of the inflation. I know the market sold off on the August inflation numbers a lot yesterday. But July inflation was more or less flat month on month. I think August was up 0.1 or 0.2% month over month. If you carry that forward for the next year, if we get 10 more months like that, we'll be on a inflation that's up 1 or 2% year over year, which is great. So I mean, I saw a lot of inflation in early and mid 21, and on all the way through 21 and early into 22, but I feel like prices have more or less stopped going up, at least based on what I can see. Prices have come down, so it should be easier to buy multifamily. But the reality is a lot of the capital on the sidelines has evaporated. Stock market's down 25%, crypto's down. The Fed is sucking liquidity out of every market, the bond markets and so on. They're shrinking their balance sheet, so it's a lot harder to get people to part with their cash right now in this environment. It's true of institutional investors, and it's true of individual investors. If you're a large institution that has a lot of on-balance sheet dry powder, it's an amazing opportunity to go out and scoop up assets on the cheap. And I think 2 or 3 years from now, those folks will have done very, very well. If you don't have on-balance sheet capital and you have to go convince people to give you capital, it's a very scary, risky time to go out and take risk and try to convince people of such, which is why a lot of operators and investors are on the sidelines right now. But I do think it's a great buying opportunity. Prices have come down. This business is not going away. And one thing that we've learned from being in the apartment business or from watching this business is that it's very rare for rents to go down. In periods of weakness, they flatten out. You get concessions, maybe you get more vacancy or non-collection, but rate really doesn't contract or doesn't contract for any meaningful period of time. And so if you can buy cheap now and ride out the near term choppiness, I think in 3-4 years, you're gonna be thankful for taking the risk and doing the work, which is why we're still out in the marketplace buying deals and trying to negotiate the very best entry points that we can on any asset so we can deliver outsized returns for our investors while continuing to grow the platform.
No, I think like you said, the marketplace and demand, while the housing demand is strong, the uncertainty, uh, keeping some of the investors on the sideline, but sounds like, as we kind of sort it out, there are going to be some opportunities, and for those with capital, should do well. So that's good. Hey, if we could, Craig, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, investors, tenants, the market, political landscape, however you would like to frame the question with regards to the biggest risk is for you to determine. But for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Craig Berger, what is the biggest risk?
Darren, you're a really good interviewer. You asked some great questions and you're really smart. Our biggest risk, my biggest risk, is taking a finite amount of personal resources and growing a business. I'm hiring, I'm buying deals, and am the investor of last resort or the backstop in any of my deals. If a deal needs more money, I really don't do capital calls. I've always invested out of my own pocket in the very few limited cases where one of our deals or properties has needed more money. So I've got a number of demands on my personal resources, most of which revolve around growing a business. So that's my biggest risk. How do I hire top flight and top quality, talented C-level executives, investor management personnel, acquisition personnel, back office personnel, with my resources? How do I go out and buy quality deals when I have to raise the money in a finite period of time? And so those are some of the biggest risks. On our assets, we've really paid mostly prices that I feel really good about. So I don't feel like any of our projects are a risk. Again, that's one of the great things about multifamily. We're buying below replacement cost. We're buying into a business that is fairly stable overall. So I like the multifamily and commercial real estate business. And we've never lost money on any deal yet, knock on wood. And hopefully we won't. So, my risks are more around corporate level risks and how to scale a business with, limited personal resources. We have exited, a number of properties over the last year. So my resources are a lot less limited than they were a year or two ago. But they're still limited in terms of growing a business and hiring talented people that need and deserve to make a living.
No, I appreciate all the hats you wear. That's it's one thing to invest, but it's an entire different thing, or at a whole nother level, is to be operating as the leader of a company and trying to balance and compensate those that are helping you grow you and your investors portfolio there. So I applaud you for that. Hey, Craig, where can listeners go if they would like to learn more or connect with you?
Sure. You can email me, Craig at avidrealtypartners.com. You can go to our website, avidrealtypartners.com. You can find me on LinkedIn. All of my contact information is there. And this has been fantastic. I really appreciate the opportunity to be on your podcast and have this conversation with you.
Oh, likewise, Craig. I appreciate that. And Craig, I do want to say thanks for taking the time today to talk. It's been a good one, and I've learned a lot, enjoyed it, and look forward to doing it again soon.
Awesome. Thank you so much.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.